You might remember hearing this declaration a few years back that trade wars are good and easy to win became quite a popular sentiment for a while.
Yeah, I remember that line.
But the real question, the one we're digging into today is, was that actually true? For the U.S. specifically, when it came to the tariffs on China, we're doing a deep dive into a couple of really detailed analyses. One's called How the U.S. Caved to China in the Trade War, a detailed post-mortem analysis. And we're also pulling from How the U.S. Tariff Increases on China Backfired.
Both sound pretty pointed.
They are. Our mission here is to pull out the key insights, the really important stuff, to give you a shortcut to understanding what went down and, why it still matters. Okay, let's unpack this.
Right. And to really get it, we probably need to go back to the start, like 2018, when the U.S. kicked this whole thing off.
Okay.
The stated goals were, well, incredibly ambitious. They wanted to slash the trade deficit, stop IP theft, and force tech transfer.
The big ones.
Yeah, the big ones. Plus revive U.S. manufacturing, create jobs, and ultimately sort of put the brakes on China's economic rise. It was a really bold agenda.
That definitely paints a picture of, high-stakes ambition. Shrinking the deficit, stopping IP theft, bringing jobs back, slowing China down. Big goals.
Huge.
So, as the U.S. was laying out these targets, what was China doing? Were they just reacting, or did they have their own game plan?
What's fascinating here is China wasn't just playing defense. They were actively thinking long-term, strategizing.
Okay, how so?
Well, a few things. Domestically, they used stimulus to cushion the blow, absorb the immediate pressure from the tariffs.
Right.
But crucially, they also started building new trade bridges, forging new alliances. Think RCEP, that's the Regional Comprehensive Economic Partnership.
The huge Asian trade deal.
Exactly. The massive one that, importantly, doesn't include the U.S. And they kept pushing their Belt and Road Initiative, too. And maybe most strategically, they leaned into becoming the essential supplier for critical stuff. Rare earths, EV batteries, things the world needs. So they were building resilience, finding other paths, not just waiting for the pressure.
Okay, so fast forward a bit. January 2020, we get the Phase 1 deal signed.
Right, Phase 1.
Heralded by some as a big win.
Right.
China commits to buying an extra, $200 billion in U.S. goods.
That was the headline number, yes.
Yeah.
$200 billion over 2 years.
And there were some other bits, kind of vague promises on IP enforcement, currency stuff.
Yeah, those are less concrete.
Here's where it gets really interesting. What actually happened? Did China deliver on that $200 billion?
Well, the assessment of Phase 1, based on the data, it really paints a picture of what some analysts call a Pyrrhic victory for the U.S.
Meaning, a win that wasn't really a win.
Exactly, a victory that cost too much or gained too little. The USTR's own data, that's the U.S. Trade Representative, it shows China bought only about 58% of that promised $200 billion.
58%, so just over half.
Just over half. Around $116 billion. That's a huge miss, over 40% short. And beyond that number, those vague promises on IP and currency, there weren't really any teeth, no real enforcement beyond, talking about it. And critically, no movement on the really tough stuff. State subsidies in China, forced tech transfer, reforming their big state-owned companies. None of that was really touched.
So the conclusion?
The sources basically say China offered token gestures while the U.S. eased the pressure but didn't get much in return. They kind of gave up leverage for very little concrete gain.
And thinking about the tariffs themselves, the U.S. put them on, $550 billion of Chinese goods?
That's right, $550 billion.
Whereas China hit back on about $185 billion of U.S. goods. That's a big difference in scale.
A huge difference.
So given that imbalance, who actually ended up paying for these U.S. tariffs? Was it China, or did the cost land somewhere else?
Well, this raises an important question about whether the goals match the actual impact. And the data is pretty clear. The U.S. tariffs mostly hit U.S. businesses and consumers.
Really? How so?
A major study from the NBER, that's the National Bureau of Economic Research, found over 60% of the cost of tariffs on Chinese goods was paid by U.S. importers, not China.
Okay, and those importers?
They passed those costs on. So things got more expensive. Electronics, machinery, everyday goods.
Could you give an example?
Sure. Take washing machines, a common household item. The tariffs led to a 12% price hike for U.S. buyers.
12%?
Yeah. Costing consumers roughly $1.5 billion every year, just for washing machines.
Wow.
And it wasn't just consumers. U.S. manufacturers who needed Chinese parts, steel, aluminum, electronics components, their production costs went up too.
So it acted like a tax, basically.
Exactly. It acted like a tax, and that fed into wider inflation. The Peterson Institute estimated it cost U.S. households about $1,200 a year, even before the big COVID price surge hit.
Wait, $1,200 a year extra cost before COVID? That's significant. So higher costs, inflation. What about the broader economy? Jobs, growth?
Well, far from boosting jobs, the economy actually saw a net loss of over 245,000 jobs by 2020.
A net loss.
A net loss. Almost 250,000 jobs gone. Particularly hitting sectors like agriculture, retail, anyone depending on exports.
Agriculture feels like a key example there.
Absolutely. China hit back hard, cutting imports of U.S. soybeans, pork. It was devastating for farmers. Billions in lost exports.
I remember hearing about bailouts.
Huge bailouts. The federal government had to stud in with $28 billion in subsidies just to keep farmers afloat. $28 billion.
That's staggering. And the goal of bringing manufacturing back. Reshoring.
That didn't really materialize either. Estimates suggest less than 10% reshoring actually happened.
So very limited.
Very limited. And here's the kicker. While the U.S. was focused on this, China used the time to actually upgrade its own manufacturing, moving into higher tech areas.
So they were kind of leapfrogging.
In some areas, yeah. The overall verdict from the sources is pretty stark. U.S. tariffs hurt domestic businesses and consumers more than they pressured China.
That's a tough economic outcome for the U.S. Let's zoom out a bit. While this U.S.-China fight was happening, how was China doing on the world stage, trade-wise? Did things shift globally?
Oh, absolutely. China definitely used this period to its advantage globally, made some major gains.
Like what?
Well, in 2020, they anchored that RCE agreement we mentioned, world's biggest trade bloc, U.S. not included.
Right.
They also inked a big investment deal with the EU around the same time, though that got frozen later for other reasons, but still a strategic move.
Okay.
And trade with Southeast Asia, with ASEAN, China overtook the U.S. as their top trading partner.
While the U.S. was.
While the U.S. was kind of going it alone, even putting tariffs on allies like Canada and the EU over steel.
Right, that caused friction.
Big friction. So China was out there pushing multilateralism, painting itself as the stable, reliable partner.
And the perception.
The net effect was the world started seeing the U.S. as maybe unpredictable, unreliable as a trade partner, while China positioned itself as this steady anchor.
Okay, another angle was technology. The U.S. went hard on tech decoupling, right? Blacklisting, Huawei, ZTE, restricting advanced chip exports.
Yes, that was a major front.
How did China respond to that, and how effective were those U.S. moves?
Well, the results on the tech front were, let's say, mixed, and arguably long-term, maybe more favorable to China in some ways.
How so?
China reacted by doubling down on self-reliance, pouring money into R&D, developing their own chip foundry, SMIC, to try and work around the restrictions.
Okay.
And they threw massive subsidies at their own tech companies. Think BYD in electric cars and batteries, CATL, the battery giant, Huawei's Harmony OS as an alternative to Android.
So they pushed their own champions.
Exactly. Did the U.S. chip ban hurt? Yes, it slowed China down at the absolute cutting edge of semiconductors, but crippled them across the board.
No, and in other areas.
In other really important areas, EVs, batteries, solar panels, even some telecom gear.
Right?
China actually widened its lead during this time.
Widened its lead, despite the restrictions.
Yes, they accelerated their dominance in those fields.
What about those critical supply chains we hear so much about? Did the U.S. manage to de-risk, get less dependent on China?
Honestly. Despite all the talk, not really. The U.S. is still strategically vulnerable.
Still? In what areas?
Take rare earths, essential for tech, defense. China still controls over 80% of the global processing.
80%?
Yeah. EV batteries. China's CATL and BYD make up more than 60% of the global market.
Wow.
Even pharmaceuticals. Something like 90% of the active ingredients for U.S. antibiotics. Still made in China.
So the bottom line is, not much actual de-risking happened.
Not much practical de-risking beyond some legislative talk and plans. The reality on the ground hasn't shifted dramatically.
Okay, let's circle back to where we started. The trade deficit. That was a primary target, right? Reduce the deficit with China.
The number one target, arguably.
Let's look at the numbers again. Pre-war, 2017, it was $375 billion.
Right.
Peak war, 2019, it dipped slightly to $345 billion.
It's a small dip, yeah.
But then, 2023, it's up to $382 billion. In 2024, a record $404 billion.
Higher than before the trade war started.
So the deficit actually got worse.
Mm-hmm.
How? How did that happen, despite all those tariffs?
Yeah.
So what does this all mean?
If we connect this to the bigger picture, this outcome really hurt U.S. credibility. The main reason the deficit worsened, China just got clever. They rerouted exports.
Rerouted? How?
Through third countries, Vietnam, Mexico. Goods would be shipped there, maybe undergo some minor assembly or just relabeling, and then sent on to the U.S. bypassing the tariffs.
Like the example of TV components going through Malaysia.
Exactly like that. It's a classic workaround. And strategically, the perception globally was that the U.S. kind of blinked.
Nice.
Yeah. The Biden administration kept a lot of the tariffs, but enforcement seemed lighter. There was no big phase 2 deal, no real follow-through on the tough demands.
And allies noticed this.
Allies noticed. They started doubting U.S. consistency. It's resolved. The narrative shifted. It became America starts fights it can't necessarily finish, while China plays the long game, shows resilience.
That's quite a sobering assessment of the strategic fallout. Okay, so if we tally up a quick scorecard against those initial U.S. goals.
Let's do it.
Trade deficit reduction.
Failed. It got worse.
Manufacturing reshoring.
Limited. Very limited success.
IP theft and tech transfer.
Largely unchanged, according to the sources.
China's global trade position.
Strengthened. Definitely strengthened.
Impact on U.S. consumers and businesses.
Negative. Higher costs. Inflation.
U.S. geopolitical influence and alliances.
Damaged. Friction with allies.
And tech containment of China.
Mixed, at best. Slowed them in some niche areas, but China pulled ahead in others. That scorecard pretty much nails the final verdict from the sources we looked at. The U.S. went into this aiming to reshape the economic balance, discipline China.
Right.
But it came out with very few actual wins, a bigger trade deficit, and its strategic credibility took a hit. China, on the other hand, came out looking more resilient, more diversified, and maybe even more determined to lead in key industries.
And the tariffs themselves.
Described in the analysis as economic self-harm. Basically, shot ourselves in the foot. Done without a clear, aligned strategy or getting allies on board. It mostly backfired.
Okay, that's a clear, if tough, conclusion. So, given all this, what do these analyses suggest for the future? What should U.S. policy look like going forward? Any recommendations?
Yeah, the sources do point towards a different approach. First, working with allies, rebuilding coalitions, maybe something like a TPP 2.0, the Trans-Pacific Partnership idea, using multilateral pressure, not just going solo.
Makes sense.
Targeted industrial policy, meaning the government actively investing in critical U.S. industries, rare earths, biotech, advanced chips to build up domestic strength.
Yeah.
Making future trade deals genuinely enforceable. Tying any benefits, like tariff cuts, to stuff you can actually measure and verify. Real compliance.
Right. No more vague promises.
Exactly. Also, getting ahead on digital trade rules, setting global standards for AI, data, intellectual property in the digital age.
And supply chains?
Really focus on making them resilient. Incentivizing companies to move production closer to home, nearshoring, or to friendly allied countries, friendshoring, places like India, Mexico, Vietnam, reducing that reliance on single distant sources.
So it sounds like a much more strategic, collaborative, and focused approach is needed. Which brings us to a final thought for you, our listener. Given that these sources strongly suggest the tariff strategy backfired, hurting consumers, missing goals, what does this deep dive tell us about the most effective tools countries really have today in this complex game of global economic competition?